Good morning, good afternoon to whoever you are, wherever you are in the world. Welcome to LBMA webinars. We have a lovely webinar planned for you today, LBMA 2021 Price Forecast Review. So in a moment, I will hand over to our host, Frederic Panizzutti. But what I'm going to do first is I'm going to take you through a housekeeping slide. If you have any questions throughout this webinar, things you want explained further, or questions about where you think this is going to go, just submit them in the Q&A panel at the bottom of your screen. If you can't see it, can't find it, you don't know what I'm talking about, you can also email us at ask@lbma.org.uk. Someone will pass that across. And if we don't get through to your questions on the webinar, we will endeavour to get back to you outside of the webinar. So I will hand over to Frederic now. He's going to start off with the price forecast survey that we conducted at the beginning of the year. So Frederic, over to you.
Thank you, Taylor. Today, panelists are Rhona O'Connell from StoneX Financial Ltd, London, Rene Hochreiter from Noah Capital Siberian Research, and Thorsten Polleit from Degussa in Frankfurt. When the forecasts were published in January 2021, the gold price was trading above 1900. 3 months later, gold is trading around $200 lower. So today we will try to analyze what prompted the gold price to drop and what to expect next coming few months. We will also touch base on other metals. Thorsten, I believe you were among all analysts, the analyst that had the highest forecast in the survey. You were forecasting a peak at 2,680 and an average of 2,300. Are you still confident gold will reach your targets this year? And can you explain why?
Well, Frederic, I must admit that I wish you had drawn our attention to the $2,300 per ounce average price for 2021 rather than to the upper limit of the forecast range, which I consider as a probabilistic forecast. And yes, as a possible event still. I'm rather optimistic that the latest price correction, which set in August 2020, and which I have underestimated as far as its intensity is concerned, will come to an end fairly soon, and that the price of gold will actually return to its, let's call it long-term upward price trajectory. The price of gold is, as you all know, driven by numerous factors. But I'm inclined to think that its underlying trend is basically determined, strongly so, by the expansion of the world's money supply. And maybe, Taylor, you can show us the slide, my first slide in the, yeah, I think that's it. It shows you the price of gold in US dollars per ounce from January 2000 up to March 2021, plotted against the US money stock, which I take as a proxy for the world money supply. And if one assumes that over time, the price of gold follows the trend set by the expansion of the quantity of money, it suggests a current gold price of around about 2,100. And if we factor in that the US administration, and I learned that yesterday, is actually launching an additional $2 trillion deficit spending program, which is likely financed by additional money printing, we would be moving towards something like 2,300. Of course, it is not as simple as that. But if you set up a model for the long-term relation between the gold price and, let's say, short-term real interest rates and a measure for credit market conditions, and you plug in the current data, you would also end up with a fundamentally justified gold price, as I would put it, of around 2,300. With a rather large standard error, though, I have to say. And just to cut a long story short, I think there's great opportunity right now in the gold market, right in front of us, with the gold price having fallen well below its, as I call it, the fundamentally justified value. So I would encourage long-term oriented investors to build up exposure in the gold market right now.
Thank you, Thorsten. Rene, on the other hand, you were the most bearish analyst in the forecast, and you were predicting an average of 1,650 on the back of a strengthening dollar, rising equity, and a fast recovery in China and in the US. And it seems that your scenarios we seem to be in the middle of that scenario. Are you still looking at gold to average 1,650?
I'm still looking at the same sort of average for the year, yes. I must admit, at the beginning of the year, when I was putting in these forecasts, I actually had two scenarios ready for the LBMA survey. The one was exactly the same as Thorsten, $2,300 an ounce. The other one was 1,650. And then I thought, what is this world going to look like in a year's time? Because the market, of course, looks ahead, doesn't look backwards. Then I thought, well, inflation is not going to be there. Long-term rates are probably going to go up. The dollar's probably going to go stronger. It can't carry on going weaker as it did towards for the most of last year. And various other ones like the Bitcoin, for example, it's gaining traction with Elon Musk now buying into it, and you can buy a Tesla using Bitcoin. It's one of the competitors for gold. Less stimuli. Well, we saw yesterday Biden said possibly another $2 trillion of stimulus. So that goes against my sort of forecast. But in general, I look at 8 different factors, and gold is a funny thing. It attaches itself to one factor, and then it attaches itself to another factor. But on balance, every single one of those factors that I looked at, except for maybe Bitcoin, they're pointing to a weaker gold price. And that fact is still in place, and possibly not 1650. Maybe if I had to readjust, I'd go to 1700 for the year. I agree with Thorsten in the long term. Gold goes up 2%, 3% per year against the dollar, and that's the way it's always been. But for the LBMA survey, it was the question: what's gold going to do this year? And I think it's going to correct quite significantly this year. So the correction is not over yet. Second half of the year, possibly a bit of strength, but not yet.
Thank you very much, Rene. Rhona, you were on the bull side, predicting an average at 2084 on the back of geopolitical risk, an increase in economic stimulus, and negative real interest rates. Are you still holding your forecasts?
On a mark-to-market basis, Frederic, I don't think I can, because to average 2084 this year, we would need to average ever so slightly shy of 2,200 for the rest of the year. And I'm not convinced that's feasible. I remain in the bull camp, though. I can understand why the price has done what it's done over the past 3 months. And when I was looking forward, when we were doing the survey, and obviously, as Rene says, we're looking forward because prices are discounting future expectations as well as existing conditions. One of the areas that captivated my attention probably more than anything else was again, and here I'm with Thorsten, is the amount of money in the system. The IMF estimates, for example, that central banks as a whole injected something of the order of $12 trillion of additional liquidity into the global markets over the course of last year. Obviously, that has not stopped. We saw what President Biden was saying yesterday. I actually suspect he's going to have quite a lot of difficulty manipulating, that's the wrong word, talking through both sides of the political divide, because obviously there is a bifurcation within the United States, and it's a relatively evenly balanced Congress, although obviously the Democrats do hold sway just. So I think it will go through, but I think it's going to take longer than the administration might hope for. But nonetheless, if we look to the longer term, we still have a considerable excess liquidity in the system. There's a lot of money looking for a home. And we certainly know that there are fund managers who are looking at gold as a risk hedge, maybe not quite yet, maybe waiting for a further dip. But the proliferation of negative interest rates, both on a real and a nominal basis, is not going to go away in the near future. And one of the things I think seems to be sidelined at the moment is the continued rhetoric on the part of the central bankers, with Jay Powell in the vanguard, to the effect that rates will stay lower for longer, which I read actually lower for much longer, until the Fed has achieved its average target of 2% inflation. And one of the elements that has been working against the gold price recently hasn't been the concept of inflation, it's been the concept of what bond yields are going to do with the expectation of inflation. And obviously we've got a good relationship between gold and the 10-year bond in particular. But that to some extent, to me, seems to be that some observers are seeing inflation as a threat, whereas in fact it's not, because you need a little bit of inflation in the system in order to encourage expenditure and investment. So on balance, I would hope that that realization will sink in once again. Rates are going to stay negative, and the pursuit of yield in emerging markets is perhaps a little bit risky, and I think gold will come back onto center stage.
Thank you, Rhona. Both of you, Rhona, Thorsten, mentioned that the monetary expansion could give gold a positive push. But what will happen the day governments decide to go into monetary contraction? How will this impact gold? And when do you believe we will start to see that?
Me, Thorsten?
Thorsten?
Sorry, I think I didn't get your question.
Yeah, both of you mentioned that the monetary expansion is having a positive effect on gold. But at some point of time, we might expect governments to go the other way and to go for monetary contraction again. How do you think this will affect gold?
Yeah, well, very interesting question, Frederic. As I already pointed out, and as Rene and Rhona also pointed out, the expansion of the world's money supply provides support for precious metals in general, gold and silver in particular, because I think these metals are still being traded as a kind of near money, at least over the medium to longer term. And I think at this point it is important to face the fact that the world's monetary system is actually in deep trouble. It's not just a business cycle problem. We have to deal with an unbacked paper money system in which new money is created out of thin air, be it the US dollar, the euro, the Chinese renminbi, or the Japanese yen. They're all unbacked paper money systems. And we know that these unbacked paper money systems are economically and socially destructive schemes with far-reaching and harmful economic and societal consequences beyond what most people would imagine. This unbacked paper money is inflationary, so it loses its value over time. And I would add at this juncture, of course, there is inflation in the system. Consumer prices have remained relatively tamed so far, but look at asset markets. Stock prices are getting pushed up. Real estate and housing prices are getting pushed up. The bond market gets pushed up. It's a huge and I think the largest bubble the world has ever seen. And what is more, paper money issuance benefits some at the expense of many others. It causes boom and bust cycles, and it will ultimately end, I think, in a rather problematic situation, namely a situation of over-indebtedness. And at this juncture, I just want to refer to the latest numbers by the International Finance Institute. It estimates that global debt towards the end of 2020 amounted to $281 trillion. That's around about 355% of GDP. And that is the reason, I think, why interest rates won't go up in real terms. As Rhona pointed out, the likelihood that interest rates will remain negative in real terms is very high from my point of view. And gold and silver are two possibilities to seek portfolio insurance. And in the latest months, of course, people were carried away by rising stock prices. And as Rene said, they were, getting into Bitcoin and other crypto units. But sooner or later, I think people will realize that gold and silver are the natural hedge against a worldwide monetary system that is increasingly spinning out of control.
Thank you. Thank you. Over the last couple of weeks, I saw many reports that stating that investors could be shifting out from gold to go into Bitcoin. Most of these reports were mentioning that Bitcoin is shadowing gold. Rene, do you believe, what is your stance on that?
I think, Bitcoin is very similar to gold. It has no net present value. gold mines do have net present values because they have a dividend flow, but Bitcoin and gold, they themselves don't produce dividends or anything like that. It's a greater fool theory. You look towards somebody buying it, at a higher price if you invest in gold and platinum. I understand the background and all the drivers of the gold price, but Bitcoin is very, very similar. And in fact, one of the funds, a gold fund in South Africa, actually made an investment in Bitcoin. I think it was last year or the year before, and did very well out of it. To me, Bitcoin, it's still a cryptocurrency. It bypasses the banks, so it makes the banks feel very uncomfortable. But it is, to me, it is a challenge to gold. There is, yeah, let me leave it at that.
Thorsten, would you like to add something?
Well, I have to say that I'm a strong supporter of making possible a free market in money. That is ending central banks' money production monopoly. And having said that, I welcome what's going on in this crypto space. I think Bitcoin has established itself as an, say, asset and as a medium of exchange for certain type of transactions. And the key question is now whether Bitcoin might become the world's money, whether it can actually replace the official fiat currencies like the US dollar, the euro, and other official currencies. And I have some doubts it will because of technical reasons. First, there's the so-called scalability issue. The Bitcoin network based on the blockchain can handle around about 350,000 transactions per day worldwide. To put that into perspective, in Germany alone, there are around 75 million transactions per business day. So the capacity is not really sufficient, I would say, given the current situation. Of course, the Lightning Network has been developed, but I'm not sure whether it provides really the safety people prefer when making payments. And the second point I would like to make is there is the intermediation issue. I think money that can work for a modern economy cannot be confined to peer-to-peer transactions. You need actually intermediaries providing services such as safeguarding your money and doing settlements. And once intermediaries enter the market, Bitcoin would no longer have the anonymity advantage it currently enjoys over, say, gold and silver. And in fact, I would consider a digitalized gold and silver money a serious competitor for Bitcoin. And so to sum up, I'm not convinced that Bitcoin has already won the race, as you can read in the financial news these days, or that it is a done deal that it will win the race. But generally, I think it is a very good development we are seeing. The market is trying to establish a free market in money.
Thank you very much. Rene, Nornickel, the world's largest producer of palladium, just announced recently that it's planning to restore its full capacity of its two flooded mines within the next 3 or 4 months. How will this impact the already imbalanced supply-demand equilibrium?
Quite significantly. Norilsk is the biggest supplier of palladium in the world, about 2.9 million ounces of palladium a year. They recently had a flood because of, and I think it's going to continue because of permafrost melt, because of global warming north of the Arctic Circle. They operate north of the Arctic Circle. And the influx of water happened in 3 different areas, 3 different tunnels. And it was only stopped last week, but this week actually. And they said that about 25 to 33% of production will be affected. So that is approximately, call it 2.8, 750,000 odd ounces of palladium that is taken off a 10 million ounce palladium demand market. So 7% of palladium is now not at risk, but it is not going to be available to the market. Prior to that, I had a deficit of about 200,000 ounces of palladium as well. So even though there are stocks of about 1 million ounces of palladium on surface above ground stocks, the fact that we're looking at 700,000-800,000 ounces of deficit this year is going to put the market into imbalance, and I think it will support the palladium price. I also think that because the palladium is used mainly in autocatalysis for gasoline cars, it is at the moment very lucky that we are there's a worldwide shortage of computer chips for the electronics of cars, and in Europe, for example, there's a lack of demand, I suppose because of the lockdowns that they're still having. So the demand for the main market for palladium is also down. So palladium, I think you'll notice that my forecast was about $2,600 an ounce for the year. I don't think it'll vary much from that because of the drop in demand and the drop in supply. South Africa's supply is continuing. There's also a little bit of a risk that South African supply in palladium is going to come down, flat to maybe down, because of certain mining problems and lack of capital allocation to capital expenditure in South Africa. But essentially, I think the palladium price should remain firm, 25 to 2,700 for the year as an average.
Thank you, Rene. Rhona, do you believe that this unsustainable supply deficit in palladium will push car makers to shift from palladium to platinum sooner than expected?
Well, for a long time I didn't, Frederic, because I took the view, and I still do take the view, to be fair, that with the electrification of the fleet and the onset of the green economy, automakers who already have pretty much stretched balance sheets would be wanting to conserve their finances, and therefore research materials would be much more likely to be diverted towards the electrification technology as opposed to tinkering at the edges with emission control catalyst loadings. But that was originally an exercise in terms of the price because of the way that palladium had considerably outperformed platinum. Where it is viable is the fact that there is, as you say, there is a persistent deficit in the market. I'm delighted to see that I'm in lockstep with Rene. I have palladium in a 750,000 ounce deficit this year also. So the prospect of thin, potentially illiquid markets, difficulties in the forward sometimes, which has been with us for at least the last 4 or 5 years, would be a determining factor in auto companies looking to work back towards platinum rather than palladium. There is some work underway already, certainly with one of the South African mining houses and one of the major refiners. But whether it's actually going to make that much difference, I'm really not that sure, because if you take a much longer term view, the electrification of the fleet and the reduction in internal combustion engines, not in hybrids because they're important there, but when it comes to fuel cell vehicles, which favors platinum, of course, there does come an inflection point where the net use of palladium goes pretty close to negative in the auto sector. But I'm looking out to almost 20 years there.
Interesting. Thank you very much, Rhona. Thorsten, how do you think the in and outflow of PGM ETFs is correlated with PGMs, and what's the relevance?
Yeah, that's also a very interesting question. Taylor, maybe we can take a look at the chart showing the total stock of ETF gold holdings and the price of gold. Unfortunately, I don't have a platinum or palladium related chart with me, but I think we can make the point by looking at the chart. As I said, it shows you the total stock of ETF gold holdings since the start of 2004, and the price of gold in US dollars per ounce. And as you can see, the two series are fairly closely and positively related. And this raises, of course, the question of causality. Do changes in the price of gold induce gold ETF in and outflows, or is it the other way around? Do changes in ETF gold holdings induce changes in gold price? Well, I think there's no clear-cut answer to these questions, but the point is the financial industry, by making use of ETFs, open up or has been opening up the precious metals market increasingly to a wider audience. So it becomes relatively easy to move money in and out. And of course, the gold and silver ETF markets have become very big. For instance, the total holdings of gold ETFs is the latest numbers were 144 million ounces. And as far as the silver market is concerned, I think one annual production of silver has now been placed with ETF, so it's sizable. And when I look at the markets for palladium and platinum, I see a similar trend. I mean, so far ETFs, the volume is much lower. For instance, annual production for platinum is around about 5 million ounces last year, and the ETF holdings amount to 2.6 million ounces, and in the palladium market, it's 500,000 ounces. I guess that's the latest numbers I got from Refinitiv. But I think it can be expected that investor interest is increasing in taking positions in these platinum group metals, and that of course can change the price action considerably, because in particular institutional investors tend to be relatively interest rate sensitive. We see that, for instance, with gold and silver ETF changes, the outflows and inflows into these ETFs are closely related to changes in the interest rate environment, and I think the similar can happen as far as platinum and palladium is concerned, and that, of course, I can imagine could be a game changer.
Thank you very much. Rhona, would you like to add anything?
I agree with Thorsten there. Just one other thing that to pick up on what he was saying in terms of the levels of the holdings in the ETFs. The platinum market is the ETF is equivalent to something of the order of 29 weeks global industrial demand. Palladium is actually much smaller. It's just under 3 weeks worth. So there is obviously scope for growth there. Whether the markets will want to take it up, given the longer term outlook for the industrial fundamentals, is open to debate.
Thank you, Rhona.
Could I make a comment there, Frederic?
Yes, of course.
Please. You know, gold ETFs is you know, there's no question it's used as an investment form. In platinum, palladium, and even in rhodium ETFs, there's two types of investor. The one is for investment purposes. The other one is as a stock of last resort. So an ETF buyer can go and buy the ETF and then ask for delivery. And that's what happened with the Chinese about a year or 2 years ago, when they took the ETF and they converted the ingot to sponge almost immediately. So that's, to me, one of the reasons why palladium is so low, because the palladium demand has exceeded supply for many years. And that's why we now have only 500,000 ounces of palladium ETFs, according to Thorsten. Because people, investors or OEMs have actually been asking for delivery of these metals.
Thank you, Rene. Rene, what do you believe the lack of capital spending in South African mining industry will have as a long-term impact on the PGM production?
The impact will be, if you want to start a new mine today, you pull the trigger today on a new mine, it will take you, for an underground mine, at least 5 years before you start getting into production, and then another 2 or 3 years before you get to full production. There are no plans other than one company, Northam, that has had the plan in place for many years now to increase production at its Eastern Bushveld Booysendal operation. But there are no other expansion projects at all in South Africa. Over the last 5 years, of course, there's been a terrible. The producers have had a very bad time in just to survive, and all their capital has been allocated to salaries and to sustaining capital, and very little, if any, to expansion capital. As a result, I do not see, other than the one company I mentioned. Norilsk did have some expansion prospects until the flood hit. But now, other than that, I see no new production in platinum or South African palladium or rhodium for that matter for the next at least 3 years and possibly even 5 years.
Thank you very much. There has been some talk circulating in the markets recently about heavy Chinese PGM purchases last year. Is there any evidence to back this up?
Yes. There's been anecdotal talk around the markets. If you talk to people who are actually making the markets, and certainly obviously we have a trading desk as well, we've seen flows going into the east, but you can actually back this up with trade figures. The Swiss trade figures show increased shipments, or not shipments necessarily, but increased change of title going into China. But probably more interesting is the Chinese trade numbers themselves. And we have those back to the year 2000. So I've just looked from the period 2010 to 2019, and then 2020 for comparison. So over the course of 2020, and particularly in the final quarter, rhodium imports into China at just over 7 tons. It came in at 7.2 tons. That was 49% higher than the average of 2010 through to 2019 inclusive. Now this talks to the rollout of 6B, the Chinese emission limits, which is actually not due until 2023, but 6A actually came in 6 months earlier than before. And obviously material needs to be bought ahead of time for retooling and recalibration and so on and so forth. And we saw a similar spike in rhodium imports into China in 2014, ahead of the rollout of China 4, which was when NOx emissions were going to be reduced by 25%. Well, for 6B, they're being reduced by 50%. So that's a lot more rhodium that's going to be required. And if you put those numbers into a global industrial context, then the incremental imports into China last year was the equivalent to just over 4 weeks global industrial demand. So they've been hoovering it up. Platinum is less dramatic, but palladium, the palladium imports in 2020 were 86% higher than the average of 2010 to 2019. So as well as what people are seeing going across the trading desks and the anecdotal conversations, the trade numbers actually underpin it.
Thank you very much, Rhona. Rene, Rhona, Thorsten, rhodium is trading almost on its high. Where do you see the gold price, the rhodium price over the next 5 years?
I see it being firm to possibly even above $30,000 per ounce level. The problem with rhodium is that there have been very few stocks in history, and there are currently in the last 3 or 4 years, there are no stocks. The Chinese are the type of consumers that will buy the rhodium and use it. I don't think they do any sort of derivatives on their purchases and so on. And you know, their economy came out first out of the starting blocks last year, way before anybody else. The only producer in South Africa, the only real producer in the world is South Africa. Norilsk is Russia is very small. North America is almost non-existent. The source of the metal, you know, is pretty much defined. Like I said earlier, there's very unlikely to be any increase in production at all. Supply is therefore constrained. Demand with China 6B and China 7 coming in 2024, and then possibly China 8 in 2028. So for the next 5, maybe even 10 years, I see for all the PGMs, I see a new paradigm. People have to start thinking differently about, you know, to the forward prices compared to the historical prices. The world basically needs these PGMs, otherwise they're not going to meet European emissions controls or Chinese or global emission controls. And I do not see, every now, I mean, the recent price action of rhodium, it goes up to 30,000, comes back to about 26, and goes up. Now it's on its way up again. But it's way above where it was about 3 or 4 years ago. And I see that sort of level in rand per kilogram, for example, we're sitting, sorry if I'm going on a bit, but it's 1.8 million rand per kilogram of PGMs. The gold price in rand per kilogram is 800,000. The PGMs are 1 million rand a kilogram ahead of the gold price. And that to me is pure demand and supply. PGMs work on, for PGMs, demand and supply works. For gold, it doesn't really work. That's one of the reasons I think PGM price is going to stay where they are.
Thank you, Rene. Rhona, Thorsten, would you like to add anything before we move to the Q&A session?
Well, I would say Rhona has made an important point. Industrial demand for PGMs from China is, of course, important, and it has remained solid last year. Note that China's economy didn't contract in 2020 as most Western economies did, and especially demand for PGMs to be used in the petrochemical and glass industry, and of course, especially for auto catalyst purposes, remained robust. And yes, China keeps showing, let's call it a healthy appetite for commodities all across the board, including, of course, PGMs. When it comes to rhodium, well, rhodium is the only platinum group metal, as far as I'm informed, that can reduce nitrogen oxides emission, and which are an important focus of the newer emission standards in Europe and in China. And as Rene pointed out, that's certainly one of the reasons why there's still strong demand for this type of PGM. However, I would say trees don't grow to the sky, as a German proverb would say. I think this holds true in particular for metals to be used for industrial purposes. For if its price becomes too high, producers start looking out for cheaper substitutes, start thrifting, or if that's not available, or if that's not possible, production gets curtailed. And to be honest, I do not have a reliable technique to come up with a forecast for the price of rhodium over, say, the next 5 years. All I can say is that I expect inflation to gain momentum, and that means a rise in prices of basically all goods and services, including PGMs. And as Rene pointed out, there is a supply shortage, which can be expected to remain in place for the foreseeable future. So maybe the price rise in rhodium will not continue. The momentum will not be as strong in the quarters and the years ahead compared to what we have seen since 2016. But the price may not decline from current levels.
Thank you very much. Well, Rene, Rhona, Thorsten, I see that we don't have any questions to answer. So I will hand over the floor to Taylor.
Hi, thank you very much for a wonderful webinar from the four of you. It's been an honor to have you on board. I'm just going to take you through some housekeeping slides. So if you'll bear with me to share my screen. If you did have any questions that came through at any point throughout this webinar, please send them through to us. I have seen that perhaps one has come through now,
yes.
But what we'll do is, do you want to answer that now, or ask that now?
Do we have a few minutes?
Maybe yeah, I mean, if you've got a few minutes, absolutely.
Yeah, we got a question. What about silver price forecasts? Rhona, would you like to start?
Yes, certainly. I have to confess that when I'm looking at the silver price, I tether it to some extent to the gold price. The mantra is that in a bull market, you would expect the ratio between the two to narrow because of silver's inherent volatility by comparison with gold, and vice versa in a bear market. Now, by working on a ratio, I suppose in some ways I might be being intellectually lazy, but I think I can probably justify it because very little of the silver market, except in extremes, and when it comes to private investment and perhaps a little bit of silverware demand, bears any relation to price. Virtually all of it is price inelastic. From the mine production side, for example, between 29 and 31% of silver mine production is from primary silver mines to which you can ascribe a viable cost of production. The rest comes out of the ground as a byproduct or co-product credit from lead, zinc, copper, gold, and gold operations very largely makes up the vast majority of the balance. Then, of course, there's industrial scrap, which again, to a large extent, is price inelastic. It's a function of past industrial activity, and that covers most of your supply side. Then, of course, we've got ETFs and the inflows and the outflows on the other side of the market, but to some extent, that is peripheral when it comes to the longer term outlook for prices. And then on the demand side, unlike gold, only 25–30%, generally speaking, of silver demand goes into silverware or jewelry or coins and medals. I'm leaving ETFs completely out of this equation. So the balance of it is industrial. So to a very large extent, with the exception of thrifting, because obviously silver has a high unit cost by comparison with base metal, very little silver demand is price elastic. And therefore, it's a little bit like palladium in that respect, because palladium is predominantly a byproduct, with the exception of Norilsk and some North American operations. So to that extent, the relationship with gold is a key. And we saw at the start, the headline in the LBMA piece on the analyst survey was "Hi-ho silver." I think almost to a man, we were more bullish on silver than we were on gold. And certainly, if you're going to be bull of gold, you've got to be a bull of silver, basically. So at the moment, it's underperformed, which makes sense. But what is interesting is that, as well as its precious metals connotations, obviously it has a base metal characteristic as well, because upwards of 60% of its demand is industrial. And what tends to happen is that if gold is not manifesting any discernible trend, then silver gets bored and starts looking at copper. And frequently you'll find that it'll either take the best of both worlds or the worst of both worlds. But at the moment, what is quite interesting is that we are seeing quite solid industrial interest, particularly in the States. And this is being driven, again, we come back to the green economy. It's being driven by electrification of the fleet, because silver has the highest electrical, and for that matter, thermal conductivity of all the metals. And that makes it very important in certain areas. And then, of course, it's a key for silver pastes for solar cells. So it may have lost its industrial base in photography over the last 20 years, but it's got some very healthy substitutes coming through. Market, I have the market in pretty much in balance over the course of the next 2–3 years. And that's another reason why gold is a lead indicator for the price forecast. So yes, I will have to pare back my silver price forecast without a shadow of a doubt. And it is volatile. I tend not to think of it as a safe haven. I leave that to gold. Yeah, tied to gold in my view.
Thank you, Rhona. Rene, Thorsten, would you like to add anything? No?
Not from me, thank you.
Yeah, maybe some further remarks. As Rhona pointed out, of course, the relation between gold and silver is relatively close. And what I observe is that since around about in the last 12 months or so, the investor interest in silver ETFs has increased markedly. The latest numbers I saw points to the fact that around about 1 million ounces of gold are now placed with ETFs. That's a record high, and it shows me that investors are becoming increasingly interested in playing silver as the chances for gold continuing its bull market remain in place. Personally, I think in periods like this, if you can expect the gold price, or if you assume the gold price to have a good run, then you should over proportionally benefit from holding silver. And so if you would ask me at the moment, if you're confident that the gold price will continue to move up, then there's a good reason to take position also in silver, because I think the return you're going to make will be somewhat higher than with gold. And my, as you learned, my forecasts are quite bullish in the precious metal space, and so is my estimate for silver, $47 per ounce. That's roughly, well, it's doubling, but it's a decent return. And I think from what I heard from Rhona and Rene, I feel really supported in sticking to this.
Thank you, Thorsten. Taylor, we have no more questions. Hand over the floor to you again.
Wonderful. Well, thank you very much for joining us all. Again, if you have any questions, or if you're watching this after the live recording and you do have any questions, please do send these through to us at ask@lbma.org.uk. Moving on to the webinars that we have coming up. In 2 weeks, we will have a PGMs update. So we're giving the webinar over to LBBM. So if you didn't get your fill of PGMs today, we will have some more discussions on them in 2 weeks. So when we come back from our Easter break. And we'll have David Jolly from Anglo-American and Justin Frunman from Savannah Stillwater. So do register if you haven't already done that. 2 weeks after that, we're hoping to do a webinar on responsible sourcing. So we're just fine-tuning exactly what that's going to contain. And we do have a kind of idea for how that will go moving forward this year. So stay tuned, and all of this information can be found on how to register, how to suggest your ideas. That can all be found on our social media sites. So on our Twitter, on our Facebook, on our LinkedIn, and again, you can email us at ask@lbma.org.uk. So with that, I'd like to thank again our host, Frederic Panizzutti, and our panelists, Thorsten Polleit, Rhona O'Connell, and Rene Hochreiter. Thank you so much for your time, and have a lovely weekend, all of you.
Thank you very much.
Thank you.
Thank you very much. You too.
Bye-bye.